Hello, thank you so much for tuning in. And today we have Danielle that has definitely asked a question that is probably something that a lot of you have a question about, and that is this. Love your videos, would like to get more info on the HELOCs and refi, which is the better option, HELOC or refinancing, right? I just want to pay my mortgage off faster. Should I just pay more on the principal? I'm going to love this answer. Daniel, thank you so much for the question. Very good question. So what's better? HELOC or refi? Let's get into it right now, okay? If you're looking to save some money, refinancing your home mortgage probably seems like a great option, right? By refinancing, you can reduce your interest rate, number one, cut down your loan term, number two, or tap into your home's equity to pay off other debts. You could save tens of thousands of dollars by refinancing. So what do you have to lose? As it turns out, a lot more than you'd expect. Lenders want you to believe that refinancing is an easy way out of debt, and they'll give attractive offers to reel you in. If you're not careful, all that money, Danielle, you're supposed to be saving can turn into even more debt. So please keep watching. I'm about to explain what lenders don't want you to know about refinancing and 6 tips you should know before choosing to refinance your home mortgage. All right, let's go ahead and go into number 1, the pros and cons of refinancing. Okay, if you're like most people, your home is the largest, what they say is investment. It's not, that you'll ever make. And by refinancing, you can use that investment to your advantage. Okay, when you refinance, you're essentially taking out a second loan to cover your initial loan. So the first loan cancels out, leaving you with a single loan. And my question to you is, what could you gain from refinancing? Lower interest rates, right? Many homeowners refinance to secure a reduced interest rate. A lower interest rate can mean increased equity in your home, and sometimes a lower monthly payment. Let's say this, okay? Let's take an example here, all right? And we're going to say you refinance your $300,000 home mortgage, 300K, right? From a 4% to a 3%. What does that equal out to? Your monthly interest rate calculation drops from $1,432 to what? $1,265, right? Saving you around $60,287 over a 30-year loan term. Now, doesn't that sound good? I mean, great. Doesn't that sound like a good deal? Not exactly. Not exactly. Remember that when you refinance, you're starting over with a new loan. And because of interest volume, very important, you could end up paying more than you would have if you had not refinanced. Not to mention, you'll have to pay lenders the same closing costs associated with your first mortgage. Now, maybe you're looking at a shorter loan term, so maybe you want to reduce your loan term instead. By reducing the amount of time you're paying, typically from 30 to 15 years, you'll usually pay less overall if you're able to afford it. My goodness, that's a lot of bleeding of cash flow, right? A shorter loan term typically means higher monthly payments. A few $100s extra might not seem like much, but this increase could put a serious burden on your funds if the money is tight at any point in time. Maybe you want to tap into your home's equity. Equity is the difference between what you owe your lender and what your home is worth. Think of it as the profit you'll get when you sell your home. Whether it's a medical emergency, home repairs or remodeling, or even a pricey mortgage payment, the temptation to use your home's equity, hey, that's understandable. It's understandable. And it is possible to take advantage of your home's equity successfully. Still, I've got to say this. The danger of tapping into that equity is that you're essentially paying the lender interest to use your own money. So let's say you bought your home for $250,000, right? Let's go ahead and take that example. We're going to erase this one, and we're going to take down another one. So we have the numbers, $250,000, right? Let's just say, all right, you bought your home for $250,000. You put down $50,000, okay? All right. And a couple of years later, the bank values your home at $400,000. All right. Hey, congratulations. Of that $200,000, which we got from subtracting, right? The bank will let you use around 80 to 85%. That's $160,000 to $170,000. But be careful. Equity loans can quickly become a nightmare. If you're unable to pay the lender, they can take your home and or leave you in permanent debt. Now, tips for mortgage refinancing. Refinancing your home mortgage can feel like being trapped inside a maze. Making one wrong turn can mean endless headaches and even more debt. And lenders want you to believe this is the only way to refinance your mortgage. We disagree. Now, remember, there's a difference between home equity loan and home equity line of credit. You want the line of credit, all right? If at all possible. So here are 6 tips to help you make the right choice on the path to mortgage refinancing. Number 1, understand the initial costs. Refinancing your home mortgage will cost anywhere from 1.5 to 6% of your principal or the amount you want to borrow. Make sure you're able to afford this fee before you refinance. Consider your new interest payment as well, okay? Even your interest rate is lower after refinancing. There are other fees and factors that can drive your payments up. So keep that in mind, all right? Now, of course, we can assist you with this. For more on how your interest rate is calculated, just let us know, all right? Remember that closing costs will be involved. These fees will usually amount to 2 to 3% of your total cost. Number 2, know your credit score. Do you know your credit score? Maybe even a rough estimate. Okay? Just like your first home loan, refinancing will take your credit score into consideration. Make sure to check your score through multiple sources. It could vary depending on how your loans or lines of credit were reported. So if your credit score is on the lower end of the spectrum, try to improve it before attempting to refinance. A better credit score generally means a lower interest rate, and even a 0.5% reduction could save you thousands. Okay? Number 3, be aware of your debt to income ratio, otherwise known as DTI. When you apply to refinance your home mortgage, lenders will take a close look at your debt to income ratio. The DTI is another factor lenders use to work out whether or not your loan is worth the risk. Now remember, living DTI is better. That's what we go over in Velocity Banking. We can show you that. So to calculate your DTI, add up all your debt payments and divide them by your gross income. You're looking for a number lower than 43%. If your DTI ratio is any higher, it's unlikely you'll be approved for a loan. Number 4, ditch the private mortgage insurance. If you were unable to pay at least 20% of your first loan in the down payment, lenders will consider you a high risk. Usually you'll be forced to pay private mortgage insurance. By refinancing your mortgage, you should be able to get rid of this added cost as long as your new loan is less than 80% less than 80% of your home's total value. Okay. Number 5, tidy up for appraisal. Absolutely. When you apply for a new loan, the lender's going to send an appraiser to make sure your home's value matches your loan principal. And remember, the small details matter. Store any items that might be lying around the outside of your home, mow the lawn, repaint worn surfaces. Do what you can to improve your home's curb appeal, even force appreciation. Maybe you got to remodel the kitchen. Who knows? Inside, make sure your appraiser is aware of any renovations or upgrades to your home, and you'll want to get the interior of your home as clean as possible. Appearances are important, very important, and taking these extra steps can add to the value of your home. Listen, even get rid of a realtor, okay? Have them value your home beforehand. Understand the initial costs. Number 6, refinancing your mortgage could seem like the right choice for you, but it comes with its share of risks. We believe you should be able to pay the lender less money and save more without all the hoops you'll have to jump through when refinancing. That's where Velocity Banking has teamed with United Financial Freedom Money Max account. Okay? With this Money Max account, you don't have to worry about interest rate calculations, closing fees, or refinancing to cut down your loan term. It does the heavy lifting for you. By consolidating your debts and tracking your expenses, the Money Max account takes the guesswork out of owning a home. Now, what's the best part about it? You won't even have to think about refinancing your mortgage. Okay? The Money Max account will go straight to work. What it'll do is it'll calculate the most efficient path, there's that word efficient again, the most efficient path to a debt-free life. Would you risk taking out another loan or tapping into your home's equity if you don't have to? I didn't think so. That's why I teamed up with the United Financial Freedom and their Money Max account. In as little as 7 to 10 years or even less, you can be enjoying life without paying up to 30 years of mortgage payments or even other loan debts. So you may not need to take out another mortgage. Try Money Max and avoid refinancing altogether, Danielle. Absolutely. Now, to learn more about this, info at velocityc.com. I'll go ahead and give you the presentation. Will absolutely let you know what you can do to get this Money Max account working for you. But I showed you the numbers, so you're not persuaded by my words, right? You're persuaded by the numbers, all right? Make the right choice. Get with us. Info at velocityc.com. Let me know how I can help you. God bless, and you have a great night.